Hi property people, I hope you find value and enjoy the information that I will be sharing. The purpose of sharing this valuable information is to equip you, to educate you, and to assist you in building a profitable property investment portfolio and to fast track your way to financial freedom. The end goal is for us all to be in a position where our active income is replaced by our passive income. So that is hopefully what this content will assist you with in the long run. I will not only be sharing positive news and stories, but also some interesting facts and some failures of my personal property investment journey, or some valuable learning experiences, as I'd like to call them. So please sit back, relax, enjoy the content, and feel free to contact us afterwards for some more specific and personalized information. Thank you. Let's dive right into this presentation. My name is Pieter van der Walt, and I'm really excited to share this information with you. We'll be looking at retirement stats, some good news finally, why property, understanding the heartbeat of property investment, including equity, refinancing, shortfalls, and break-even points. Which properties to buy? I guess that's the $1 million question. How to minimize risk, sectional title versus freehold, new developments versus existing properties, risks and basic investment rules, general tips and advice. This is our disclaimer. Please pause this screen and familiarize yourself with what we do offer and what is not on offer here. And also feel free to write to me, peter@houseofrealtors.co.za, or contact me personally if you have any requests, comments or suggestions, or need some assistance or advice with respect to property investments in general. News and reality check. Let's look at retirement statistics. And I want to emphasize at this point that these are based on worldwide stats. It's not locally influenced by political issues. This is also based on working people. So 1% of people retire wealthy, 4% with no financial worries, 95% of people reach the age of 65 and realize they cannot retire. They then have to turn to family or friends and either or continue working in that position. I believe a contributing factor to this is that the majority of people do the same thing and expect different results. We like to work hard, keep our heads down, and hope for the best. And unfortunately, that is not a formula for financial freedom always. So I hope that this presentation can help you at least think in a direction where we want to get to a position where our passive income replaces our active income needs, because then we are finally financially free. So let's look at an interesting stat. 150 million square kilometer land on Earth. There is no more land. And if we look at the world population growth, we will see in 1950 there was about 3 billion people on this planet, 2.5 billion. We're sitting at 2020 and we're almost at 8 billion people. But remember, during this time, the land remained the same. So the supply remains the same and the demand keeps increasing. So what must happen to property prices over time? It must increase. It must go up. And I'm specifically referring to major centers that offers, commercial economic activity and infrastructure. Why property then in South Africa? We've been through the worst recession in 80 years in 2008. And I believe that there were good signs of a resilient property market with respect to, or in comparison to other countries in the world. We also have the most severe anti-reckless lending regulation, the National Credit Act. And the proof is that our properties only declined with 10%, up to 10%, generally speaking, versus other countries where it declined up to 50%. So that is a good sign of resilience in my view. And also we'll just see after this with some other statistics that we'll bring up that there's a positive GDP growth outlook going forward. Interest rates remained relatively stable. And I remember a couple of years ago, everyone was saying we're not in a realistic interest rate environment, because interest rates should be at 20 to 25% like they were, 10, 15 years before that. And I, believe that we've been quite stable in that regard. Banks are financing up to 100%. Remember, banks have their own teams of actuaries and economists that advise them what they should be lending out and be comfortable with at that time. So if banks are giving 100% finance, I believe things are still very positive. It's also relatively easy, I'm underlining relatively easy to realize high returns with long-term view in property. I just want to add to the sentence, subject to buying the right properties. And I'm going to give some personal testimonies where I have made some mistakes in my property investment journey and how we can learn from that. So where I didn't buy the right properties and I didn't check the right boxes and what the end result of that was. So let's look at some good news. I'm sure we can do with some good news. So inflation in 1986 was sitting at 20%, 2008 11%, and now 2019 we're in the 5 to 6% target range. I believe that's a positive. Harvard Center for International Development predicts a 4.9% average growth for South Africa up to 2026, and that's based on their research models and what they do. That's also averaged out. So they believe, if you go and read this article, that the political instability or pressures in the country will stabilize. And if that is true, I believe it's a fantastic future for us in the next couple of years. So South Africa and New Zealand has the most transparent budget in the world. China last. I wonder why. South African debt to GDP ratio is sitting at around 48%. The World Bank actually recommends up to 60%. So that is a healthy percentage at this point. The US is sitting at 100%, Japan 200%, and UK, where everyone has been running to, is sitting at 90% until Brexit. JSE is ranked third in the world in terms of regulation. That's a positive, and that also gives us some stability and also sustainable growth, I believe. So it eliminates the negative consequences of greed. If we look at what happened with the 2008 recession in terms of the deregulation of derivatives and what that has caused in the US and the ripple effect worldwide, I think it's very good that we're sitting, third in terms of regulation. South Africa is ranked first in platinum, second in palladium, fifth in gold, and seventh in coal output. So SA is also ranked second for good credit practice for business loans, and the South African stock market in 2016 was ranked 18 in terms of market cap out of 140 countries. South Africa is ranked 23rd out of 81 countries in terms of the most transparent real estate market. That's a massive positive, and I also believe that is also a contributing factor for sustainable growth. SA is ranked 32nd out of 81 countries for the size of US dollar reserves, ahead of Australia and Sweden. Nice to beat Australia there. And SA is also ranked 37th out of 192 countries for the biggest exporters. SA is ranked top 20 countries in the world for agricultural output. And if you want to go read more, there's actually 21 points here. Very interesting points, a lot more detail. There's the link. Okay, so let's look at some interesting facts and figures. We're going to look at 4 concepts: equity, shortfalls, break-even points, and also refinancing. These 4 aspects or concepts are really the heartbeat of property investment. So please, if you haven't dealt with this before, make notes, and we really hope that it will help you in your property investment journey. What is equity? Equity is the difference between your asset value and your outstanding bond or your liability. So if I bought a house or apartment for 1.3 million, my bond is 1.3, my market value is 1.5, it means that I have equity available or equity locked up in that transaction of 200,000 Rand. So a nice property or development to have a look at where we have similar projections is the linksvillage.co.za. So let's move on with equity. What can I do with equity? Number 1 is I can refinance equity to access the capital, and if I use that to further my property portfolio, subject to a couple of conditions, that money can be tax free. So have a look at, I think it's section 11A of the Income Tax Act. Very interesting option, and definitely one of my favorites. The second option is I can sell the property, and that means that I would have to pay disposal fees, including estate agent's commission, capital gains tax because it's an investment property, and your certificate fees. And I would also obviously need a willing buyer to pay the maximum price available, or that I'm asking. So I would also, maybe just to go back to refinancing, the process is really very simple. I would apply for a second bond on my property, and the bank would firstly assess me and my credit profile at that time, and if they find that my profile is in order, then they would grant an approval in principle. Then they would send a valuer out to the property. If the valuer then finds enough value in that property, then the bank would give me a percentage of that total amount or the full amount, depending on their models at that time. So that's a really simple process, and it's a nice way to access equity. So the third option over here is that I can offer equity as security with business transactions. I'm not going to dive into that. So that is just the concept, equity, and what can be done with equity. Next one, simple concept, shortfall. It's really the difference between your income and your expenses. So if I bought a property for 1.3 million, my bond is sitting at 1.3 million, my rent is projected at 10,500 Rand, my bond is almost 12,000 Rand. I think I worked on a 10.5% interest rate over 30 years there. Levy 1,200, rates 500, and the rental agent I'm paying in this instance 8% plus VAT. That will mean that my shortfall is 4,000 Rand a month. This would be my minimum commitment to make this transaction work. So that's the difference between my income and expenses on a monthly basis. Also, just important to note that these operational or these expenses, excluding my bond at the top, these are also referred to, so my levy rates and rental agent fee is also commonly referred to as operational expenses. So that is generally on sectional title blocks between 22 and 27%. I would say around about 25% is definitely a healthy balance or less, depending on what the block offers, etc. So, but you will find that face brick blocks with zero maintenance or very low maintenance requirements with no lifts and low security and added benefits like that, they would generally have much lower operational costs, and that is reflected in the levies generally as well. An interesting point here is all the sectional title blocks of flats, apartment blocks, are moving towards prepaid water. Now that's been a disaster in Cape Town with respect to the water restrictions. So it is really amazing to now see that tenants will have to be responsible with their water usage, and we've seen small flats like 49 square meters use 14 kiloliters of water a month, whereas after the prepaid water meters are installed, that goes down to 2 and 3 kiloliters where it should be. So yeah, that is and what then the result of that is as well that the levy is positively affected. In other words, it doesn't put pressure on the levy because the body corporate doesn't have to carry this major costs in terms of water for the blocks, because that has now been alleviated through to the tenants. So that's the shortfall. I hope that's clear. Next one we're going to look at is break even. So what happens when my rental income increases? Remember, my rental income is off a high base of 10,500 Rand. My operational costs is off a much lower base. So if my rental income goes up, that means my shortfalls will decrease at the bottom. So here we can see the effect. My monthly shortfall in year 1 is 4,000 Rand. Year 2 is sitting at 3,400 Rand. Year 3, and let's go up all the way to year 7. So this is the picture that I'm trying to highlight. My break-even point is just after year 6 years. So that means that the tenant at this point is in effect paying all my expenses, including my bond, my management fee, my rates, and any of those costs, operational costs, my levy as well, associated with this property. So that is where we want to be with a property investment. So we want to get to break-even point where the tenants are really paying for our properties in full. So this is the most interesting concept in property for me. Most people would say, I paid 1.3 million for this property. But remember, I took out a bond of 1.3 million. I paid shortfalls up to a break-even point of 166,000 rand. That's the sum of my shortfalls in this instance. So I had transfer costs, I had a bit of a tax credit as well over this time. We're not going to dive into that, but my total cost then was 165,000 rand. But remember, this I paid over a period of 6 years, and for a property that's worth 2.6 million rand. I think I worked on about 10% growth per annum. You can work on 5, 6, 7, 8% on your property software. It will give you fantastic figures as well, even at that, because of the power of compound interest. You generated equity here of 1.4 million rand. So I paid 166,000 rand for a property that gave me equity of 1.4 million rand over 6 years. So I just want to emphasize, do you see the power of property, and especially compound interest? As Einstein said, it's the 8th wonder of the world. So she's really happy about that, and so should you be. So let's look at another concept, refinancing. If I have a property, oversimplified here, with a bond of 1 million rand, it increased in value over time, and I'm sitting with a valuation of 2 million rand. That means, of course, I have equity here of 1 million rand. If I then go and buy 2 properties with a 4,000 rand shortfall each, and I subsidize those shortfalls from my pool of equity, then that will last me 85 months or 7 years. So I've done the math on that. You're welcome to do that. The interesting concept here is, as well, to emphasize, is that this, if I had to pay this from my salary, then this would have sat at over 1.35, 1.4 million rand. But because it's refinance money, it's tax free, and it actually cost me a lot less. And another factor here to consider is, I didn't build in anything for vacancies, interest rate increases or maintenance, but I also didn't factor in that these shortfalls would decrease over time. So I basically just worked on a shortfall of 8,000 rand, divided that into 1 million rand, include the monthly interest if I subtract that from my bond, and that gives me a time period of 7 years. So I hope that this is a powerful slide for you, because this is really, unlocking major value in using one property to buy another property. This is how, many of the pro investors do it. So although there's fantastic benefits with refinancing, there's also some significant risks that we have to highlight. What's the first one? Don't be an idiot. Don't go and refinance a property and use the money to go on a holiday or buy jet skis or anything like that, because that is just not wise. So use refinance money responsibly and conservatively. Interest rate increases. Remember, everything is linked to the interest rate. You're making an additional loan. So be conservative. And don't get into a position, of negative gearing. I mean, that is really can be a disaster, especially if you have a couple of properties like that. What is negative gearing? I have a property, the value is 1 million rand. I refinance 200,000 rand, but because I didn't buy the right property in the right area and chose the right investment, my property is actually sitting at 700,000 rand. So I've got negative gearing of 100,000 rand there. So, and that is especially risky when you have a couple of properties, you've got no equity available. You build a major strategy to use equity to refinance and pay your shortfalls. So just remember that, and it all comes back to being responsible with refinancing. And remember, this is a major effect. I've seen so many people really got hurt with this. Remember, if you have a strategy of paying shortfalls with refinancing, and that means that you would need to qualify for bonds, as and when you want to access that equity, and that means your profile must be satisfactory to the banks to qualify for finance. So build that into your strategy, and it just once again comes back to being conservative. And so we've mentioned that. And remember also, continuous refinancing is built on a platform of being able to qualify for finance, as we've discussed, but also on the properties growing in value continuously. So just bear that in mind with respect to risks. If those things don't happen, or don't happen like what we've seen with the credit crunch for some time, and properties move sideways or even lose some value for a time, that is really what we need to plan for up front to be able to ride out those storms. So this is also one of the most powerful concepts for me, and this is really oversimplified. So I'm really going to break this down to its simplest form. So if I bought that property, or if I buy a property for R1 million, to simplify it, and I have 8% growth, most people refer to my growth in property as the nominal growth. But remember, if you are referring to nominal growth, that means that you didn't take into consideration rental income. So that would be fair to assume in the event of a primary residence where you are living there and you're not renting out any portion of that, then nominal growth is a fair comparison. But if I'm renting out the property, I should start looking at effective growth. So if I had shortfalls of 36,000 Rand in this event, then it means equity minus total invested divided by total invested gives me my actual return. Now, don't jump on me now with respect to I need to sell it, I need to pay capital gains tax, I need to pay all those kind of things. That's 100% true and correct. Just look at the concept. So remember, I also didn't add equity on acquisition here. But my return is sitting at 122%. It's not sitting at the 8% nominal growth that I received. So include all these other things, which you can do in the property software that I'm going to suggest later on. But just note the important thing that you need to look at effective return or effective growth, which includes your rental income as well. I just want to state here that the correct method to actually use is internal rate of return. I can use this method that I've used here, if I'm looking at a 12-month period. But when I start looking at variable cash flows over time, property has 27 variables, which is taken into account with internal rate of return. So that's really the method that I should use if I want to compare it to any other investments, to give me the closest possible comparison, in that event. We'll touch on that a little bit later. So just another interesting concept for me, if I look at a traditional investment and, I start with a plan, my premium in year one, or monthly premium, is sitting at 4,000 Rand. Year two, it increases over time, and so hopefully does my fund value as well, linked to all kinds of things. So I'm sure everyone would agree with me that this is the general trend of a traditional investment. So if I look at the dynamics of a property investment, so my shortfall is sitting at 4,000 Rand a month. My value is sitting there at 1.5 million Rand. I should have actually, made this column equity to give a fair comparison, but we can even take that column away. What happens to my shortfall in year two? Decrease, and we've seen what that does over time. So in year 7, this property is actually paying me to be my property. It's actually paying me to be my investment, and that is very important, when comparing property to other investments. Remember, I'm not promoting here that cancel all your traditional investments and just do everything in property. I don't think that will be wise. Speak to your financial planning. That is hopefully someone that is also a property investor and can also give you some sound property investment advice. If he's not a property investor, then I would suggest that you look out for a broker that is pro-property and can give you a holistic approach to financial planning. Righto. Another interesting statistic. So I've just pulled this from Lightstone, and this gives you, that's very interesting information that you must definitely have a look at. They give quarterly reports on growth, and if we look at this, the Western Cape is sitting at 7.6%, and if you compare that to places like Gauteng, is sitting at 2.6%. So that was very interesting for me to note. But also remember, this is illustrated as an average. Sub-economies also exist, and sectional title versus freehold, coastal versus non-coastal, developments versus existing properties, area value bands, entry-level, mid-level, luxury, high-end properties. So, and then even smaller segments. Remember, you can go into an area and within 100-meter radius, then the property prices can differ substantially because of various factors that contribute to the desirability of that property. So like, if we're looking at security complexes versus non-security complexes, if we're looking at the location, I've been in Langebaan recently, I can't remember the street name, but the one street you find these mansions, and literally one of the side streets, that go off, you can see that the properties are generally much older, haven't been renovated, the upkeep haven't been so good, and I can bet you, if you look at this more desirable street, where everyone, has renovated and kept it, up the look and appeal, there's a substantial difference in the prices of those properties. So that's the point that I'm trying to illustrate there. Last but not least, this is property software that I use. I'm not affiliated to them, so please go and check it out. What I like about it, I think it costs about 800 or 900 Rand. It's once off, so there's no monthly commitments or subscriptions. And you can add in all your assumptions, and it gives you up to 30-year projections and models and graphs and all kinds of things. So it's fantastic software. I love to use it, and internal rate of return is used here and various other methods as well. So also, another very interesting website to go and check out is Mortgage Professor. There's the link. There's some very, very interesting information with respect to optimizing your bonds, the effects of paying a little bit extra every month, the effect of paying your first installment a month earlier. So very, very interesting aspects to mortgage financing that I would definitely recommend. So let's look at economic cycles. So this is just important, especially newcomers in the property market. When prices are down, like Warren Buffett says, be greedy when others are fearful, and fearful when others are greedy, because he knows everything moves in cycles. So, property market also moves in cycles. Historically, it's generally 7 to 10 years, and I would say we're sitting at about a year on this cycle at this moment. So, there's various factors that contribute to this, but if we look at this increase in property prices, increase in interest rates, share market peaks, then there's a decrease in share market, decrease in commodity price, decrease in overseas reserves, stagnating rents. We've seen a bit of a correction in the rental market recently, especially in Cape Town. Finance is harder to obtain, although we haven't experienced this. Interest rates drops. In fact, we've actually, this is quite interesting, we've actually seen that banks have quite a big appetite still at this point to provide finance. Properties have no or sideways or negative growth. Unemployment rates increase. People are downsizing a bit. And then we see the upswing again. Share prices increase. Commodity prices increase. Overseas reserves increase. Rent increases. Finance easier to obtain. Increase in property prices. Increase in interest rates. Shares peak. And so it goes. And so it's been going for a long time. So that's just understanding the general economic cycles that property also forms part of. So this is completely my opinion. I might be completely wrong for some people here. I've just, formulated an opinion based on my experience dealing with investors and obviously myself over the last, many years. And this is what I think. I don't think one size fits all. What I mean with that, the best property investment for one person might not be the same as for another person, even though technically and mathematically it is considered to be. Let me quantify that. For instance, a flat in a block in Johannesburg Central might be a fantastic investment according to the property gurus. And I mean, I've met a person that is part of an organization. They own 3,500 properties in the inner city of Johannesburg. They've got a fantastic setup. Their business is sound, and every property investor on earth would say that they've done the right thing. So, but the problem is, the thing to note is that they are highly skilled and experienced to target distressed sectional title apartments where the block has been placed under administration. So that means that all legal action is cancelled against that block, who got into a position most probably for not paying levies, and the block deteriorated over time. So they target those kind of apartments. So that is a fantastic strategy for them. They have the skills, experience, teams, tried and tested methods to mitigate the risk, and like I said, the property might offer a fantastic return for them. But if I'm an old granny in Cape Town, 70 years old, or even if I'm a youngster here, I'm getting into property, and this is my first property that I'm considering is a flat in one of those can I say sectional title block of apartments that's been placed under administration, it might turn out to be a disaster for me, because I just don't have the skill, I don't have the experience, I don't have the quality support up there, and I don't understand the risk. And that's why I say that one size does not fit all, in my opinion. Though I think as a general question, there might be some basic underlying principles that can form the foundation of a good property investment. So I'm just going to give some basic information here, and I think if you're thinking in this direction, then you are ticking off the pros to a sound property investment. Your due diligence is moving in the right direction, if I can put it in that way. So I would look at security complexes in South Africa, and the simple reason is because of the high crime rate that is not really improving. So people want extra security. That is definitely a basic need. I look at 1 and 2 bedroom apartments, 30 to 70 square meters, plus entry-level townhouses, of course, in security complexes. That targets the upcoming middle class, which is the biggest segment of the market. It's also close to commercial and economic activities. This is so important because I always think of Strand, 10, 15 years ago, the residential market was completely overdeveloped. There wasn't enough work. It was too far out of the major centers for people to actually live there and drive to town. The traffic was too bad. So what happened is that these properties were experiencing significant vacancies, and I mean market values were severely negatively affected. So that's why I say the first thing, and this is probably one of the most important lessons, is to look at why is it desirable to be there? How accessible is it? How central is it? What is all the amenities that's close to it? Good schools, shopping centers, sports fields, access to various areas. So that's very, very important as a starting point, because that's why that is a driving force for people to want to live there. So that I'll carefully consider. Good income and growth prospects. So when I started out in property, I was all income, and everyone was just talking, Kiyosaki and all these guys were just talking about cash flow, and what a valuable lesson that is. Over time, however, in Cape Town, I've experienced a little bit of a difference with respect to identifying investment property. I'm not saying going for only cash flow is bad. We've got some fantastic opportunities that we sold. Friends of mine bought here in Cape Town, and they are so happy. They've got fantastic yields, though they had limited growth. And that is my next point. So I would personally look at something where I've got fantastic income opportunity, maybe a little bit more limited, but I also have growth opportunity, so a little bit of the best of both worlds, because that gives me an exit strategy. That tells me that the property will most probably grow, and if I am in trouble in a year or 2 or 5's time, then I can walk out and at least make some money in the deal, or definitely not less than break even. And I think that's that is quite vital. I bought those properties up in Joburg, and I didn't tick all the boxes of a proper due diligence. And just to give you some perspective, all 3 of those properties 12 years later are worth less than what they were when I bought them. My rental income remained sideways and my expenses quadrupled. So that is a good example of a bad investment property. So good lessons to learn from that. And that's why at the moment, especially in Cape Town, I also spoke a while ago to one of the top, I would say the top, I'm not going to say his name, I respect him very much, but the top property investment educator in South Africa. And he told me, and I was very surprised, I went to one of his seminars and we had lunch afterwards. And he told me that he doesn't own property in Cape Town. He just doesn't like the Cape Town market. And, I found that very interesting. So, and that's just proved to me as well that our market is a little bit different than maybe, up in Joburg, where we can experience a little bit higher yields. And I would sacrifice a bit of the yield for growth opportunities, just for that exit strategy if I need to exit, or if I need to refinance. If I need a safety net, then at least I know that I will experience some growth because of the location. Anyway, let's move over to the next one. Equity, additional value on transfer. I would definitely look at that, for property investment. There's 2 ways to get that. The one is buy a distressed deal and go to auctions and these kind of things. I just want to say at this point, if you are new in property, don't think you're going to go to a property auction and on your first auction you're going to buy a property 40% under market value. It just doesn't exist. It doesn't work like that. You need to educate yourself. You need to invest in yourself. You need to learn to understand intrinsic values of property and ways to unlock additional value in property. And then you also need to understand and familiarize yourself with the risks of auctions. What is guaranteed in terms of vacancies and all those kind of things? Is it a VAT transaction? Is it not a VAT transaction? Those elements can have a major impact on the profitability of your transaction. So distressed deals is definitely a place where you can buy properties with that offers immediate equity on acquisition, and they also come in various forms, not just distress auctions, but you can also here and there pick out a nice deal where there's a motivated seller and that is just looking for a buyer that want to exit the deal. I've actually done a deal like that last year, my business partner and I, and we did fantastically well with that. So let's just move here. So the equity, so that can be refinanced immediately, to expand the portfolio tax-free, like we've covered earlier in the refinancing thing. So that's the nice thing about immediate equity on transfer. The second way to, what I say is it might be a little bit of I'm saying might be a little bit of a lower risk, because if you identify the wrong development that's driven by emotion, then I would say it can actually be, quite a bit more risky. But you can also buy a new development if you buy early enough and there's enough time up until transfer and the price per square meter is within reason. So if the general going price is 20,000 Rand a square meter and, guys are asking in another development 23,000 Rand a square meter, then it's most probably got something to do with irrational exuberance, and that would be red lights for me. So especially if they're offering, similar, offering the same in terms of size and finishes and relative location. So, right, next one. Century situated close to schools and amenities. We've covered that obviously because it's less traveling time and adds to future resale value. One must also always remember that even if there's elements that doesn't really interest you, if it's a generic or universal benefits, then that's fantastic for future value, because that means that the average person that might be looking to buy there in the future might find that very attractive. So especially, we see sometimes with old people, buying a small house and then there's a artificial lawn at the back, and then they say, yeah, but I don't, but we don't really need a garden with artificial and a water-wise garden. But they must remember, if you resell that property in a year or 2 or 10, or when you're moving on into an old age home, then that will be very desirable, for other buyers. Right. And the most important point, and people don't realize this, especially when they're new in property, is who is going to manage that property? The block, the maintenance, the upkeep, who's going to be the management agent, number one. Number two, who's the rental company? We've seen so many blocks go down because of bad management, because number one, there's too many rental agents involved, different screening rules, different sets of screening tenants. So, and even when many owners start getting involved in doing their own rentals, and they just put every Tom, Dick and Harry in that has a nice smile, that's a disaster. That is completely the opposite of good quality control. So we need to regulate quality tenants and the general upkeep and appeal of the properties where we will be investing, and that's why sound management behind it is very, very important. So who are you? I've divided this is just for me, once again, my opinion, and this is 3 basic categories. I know there's probably more, but you're either a novice, amateur, or expert investor. Novice, you don't own any property yet, you're in the learning process, you don't understand risk yet, you're driven by emotion, and there's a part of you that wants to tell your friends how many properties you own. You want a huge number of properties. That is super important, almost more than anything else. So a part-time investor bought and sold and or refinanced some deals. It's considering structures for tax efficiency, i.e. trust companies, those kind of things. Maybe not sure about strategy and goals yet. Learning to do own due diligence, has some level of understanding of risk. I just want to add at the bottom here with a novice, also novices tend to also be very interested in buying with other people, partnerships that can turn out to be sinking ships. Let's look at where we all want to be, at an expert investor. So they are experienced, they bought, sold, and refinanced various deals, even maybe subdivided, some land, and made some interesting returns with that, using structures for tax efficiency, has time and skill to find gems and understand risk. This is typical your guy that can go to 20, 30, 40 auctions. He's got the time and the skill. He knows where to go. He knows how to find distressed deals, and he understands the intrinsic value of property. He has a strategic, unemotional, and calculated approach. It's not chasing numbers, but ultimate investment excellence. So I just thought that, that's who, in my opinion, we should strive to be with respect to property investment. Then we're eliminating elements that can really turn out to be a disaster for us. Right. Let's understand the differences. We get this question a lot. What's the difference between sectional title versus freehold, new developments versus existing? Once again, my opinion on a couple of these. Sectional title apartments generally offer higher yields. And the reason is because they are generally cheaper than freehold properties. I do want to mention, however, you can also find freehold properties that's not in security complexes, that is still in desirable areas, and they actually can offer some fantastic yields because there's no levies, and that makes quite a difference. So I don't want to exclude that component of that argument. So next one, higher initial vacancy risk. Remember, if you're buying in a sectional title block or apartment, it's either built in phases or it's built, as a whole block. And that means that many units will be dumped on the market at the same time, which means that there will most probably be an initial vacancy risk until the market can absorb the amount of rental properties. So where with freehold properties, they're not built in bulk, you will find that they would be built and completed individually. So the market, it's much easier to absorb the rentals with respect to individual units, coming onto the market, in comparison to bulk units. Sectional title apartments generally are tenants predominantly, so we find that in some instances it's 100% tenants, and it's the opposite with freehold properties. So, I mean, we have a rental book, a large rental portfolio, and we also manage in freestanding complex, homeowners association complex, and there our stats are about 25%. So 25% of the people that bought for investment purposes. And the nice thing about that, and you can see it, is that the owner occupiers have a vested interest. They want to make sure the complex is secure, so they put in significant drive and effort to make sure it looks nice, make sure that it's secure, and that ultimately protects your investment. So that is definitely an upside with respect to freehold properties, is that it's lower amount of tenants, so less competition in effect, and also that the owners with a vested interest are really interested in the success and well-being of that complex. Sectional title has higher levies. The reason is common property maintenance, exterior maintenance, that all forms part of the body corporates to maintain. Whereas with freehold, normally, if you buy in a homeowners association, which is just a complex with, freestanding houses, then the exterior are in many instances the responsibility of the owners that needs to comply when they paint their place in 5 years or whatever. They need to comply with the design guidelines. So that cost won't be for the homeowners association, and that's one of the main reasons, for the difference in levies as well. I think I've mentioned this earlier with the new prepaid water meters that actually, assist sectional title units to decrease. Sectional title or body corporates to decrease the levy amounts, because owners or tenants are actually taking up that cost for prepaid water meters. So a sectional title, normally more affordable, price plus acquisition costs. My acquisition costs, transfer costs, and it's just because of the lower price, because we work on sliding scale, and obviously the opposite of that with freehold, generally speaking. There's generally lower risk of expensive maintenance, and just the opposite of that with freehold. And the reason is just because it's a larger area. This is 30 to 70 square meters. In this instance, we're probably looking at 90 to 140 square meters. So there's just a larger space with a garden, most probably, that needs to be maintained, and that obviously adds to the increase in maintenance risk. Greatest segment of the market and for long-term demand is your apartments, especially up to, I'd say, mid-range or the luxury apartments. And the freestanding houses is definitely a smaller segment of the market, which can, bring some long-term risk. I've seen that now with one of my own properties where, because of the correction in the rental market, I couldn't increase the rent because I would have taken the risk to lose my very good tenant there. So I actually decided to keep the rent the same. And yeah, that's a typical example. So proper management is vital. It's actually vital in both instances. So I'm not going to elaborate too much on that. And can spread the risk potentially over two properties. Because it's cheaper, and on the other side, because it's generally more expensive, I don't have that ability to spread my risk as much as with sectional title apartments. So let's look at the next one. New developments, existing properties. What is the difference? New developments, you must remember, there's guarantees and warranties. You've got NHBRC guarantee, and obviously your defects, that's covered by the Consumer Protection Act. That is fantastic, to have. And with existing properties, you are only covered for defects that the seller was aware of that he didn't declare. And remember, you must still take him to court with that. And but that's the protection that you have under the Consumer Protection Act. General with new developments, there's nothing to spend. with existing properties, when you're buying under market value, the most value really lies in renovation projects, and that comes with additional risks. If you haven't done that successfully before, to put those teams together and manage those teams, and obviously manage your downtime before going to the market, all of that is a skill. And that's something that you would have to get on top of when you are going in for those kind of transactions. New developments, new and happening places are loved by tenants. And we've seen this now. We have some properties in Century City that we're renting out and managing on behalf of clients, and we've seen now, one of the old blocks there is Villa Italia, and I lived in Century City many years ago, and when those blocks were the happening places, and now with the new buildings apartment that was built there, tenants just want to go into the new buildings with almost similar rentals, and we see that the old blocks are definitely less desirable, and who would have thought that? That's in Century City. It's in the middle of everything, lots of commercial, economic activity, etc., etc. So just know that from a new development point of view, that is definitely can be more desirable by tenants, and whereas existing or established areas can suffer a bit when new options are available. New developments are generally more expensive, and part of the reason is the developer has to pay 15% VAT to SARS. So, and building costs, even though property market prices might go through cycles, building costs don't come down. So to build becomes more and more expensive. To put services in, I sit in some of these meetings, and it is frightening to look at the numbers with respect to putting up a block like that. So those things are going up and up, and that is why new developments will generally be more expensive. Existing properties more affordable. New developments will often lower yields because it's a bit more expensive. Existing properties, because you can get in a bit under market value, will offer higher yields due to lower prices. There's no or limited management track record, remember, because the block must still be built. With an existing block, you can go in, you can have a look at the financials of the body corporate, and you can have a look at the rental track record, etc., etc. So that is a comparison in terms of that. Potential equity on transfer with a new development. If you bought early enough, you bought the right property, there's good prospects in the right market for equity, to be available on transfer, as we've discussed earlier. With existing property, if you know what you're doing, you can have immediate equity available, after transfer in 3 months' time. So that's the difference there. Transfer costs with new developments can be much lower because the seller pays VAT, and sometimes also includes transfer and bond registration fees, or either or. Whereas with existing properties, those costs are never included. You have to pay transfer duty, and obviously, budget for your renovation costs and your attorney costs as well. Initial potential vacancy risk for a couple of months with a new development, and the initial vacancy risk with the existing property is actually less due to limited competition. So because there's not 100 units available, there's probably 3 or 4 or 5 units available for rent, and that's something to consider. There's generally higher shortfalls with new developments, and on existing properties there's lower shortfalls. But on the other hand, there's definitely lower or very limited maintenance in the first couple of years if you bought a good property. Whereas I've seen some disasters with existing properties that might require higher maintenance. My in-laws bought a house in a very popular estate in the northern suburbs, and I think about 6 months after they moved in, they realized there was a problem with the piping that was substandard pipes that was used, and all those kind of things. And it was after the guarantees or warranties period, and they had to dig it up, and I think it was 100,000 rand. So those kind of things, obviously that's a horror story, but those kind of things are possible also with existing properties. If you don't do your homework right, you might just go into a long-term or medium-term special levy, for special maintenance that's required, in the building, and that as well. So those are the kind of things that we need to look out for in that respect. Okay, let's look at some risks, and then some mitigating factors for some of those risks. So firstly, overexposure. Where are we now? there we go. Overexposure or overcommitment, bad cash flow. That is really the bottom line of everything, even in business, is respect the bottom line of cash flow. Overexposure means that you just can't qualify for more bonds, so refinancing is out of the question, and you are, have a great potential to run into cash flow problems because your reserves are depleted. And so many people find themselves in that position. And really, if you take a step back to right in the beginning, the type of property and characteristics of the property they chose could have made a big difference, and obviously the strategy they chose to follow as well. Oversupply of rental properties, market corrections, we've seen that now. We're actually in a market correction at the moment because we had a bit of a runaway market in the Western Cape. I mean, areas like the City Bowl, who would have imagined, lost rental, had to go through rental corrections of up to 35%. So just to reduce vacancies. So yeah, that is possible. Make sure that, when you are looking at doing your due diligence on investment properties, that you factor those kind of things in, and that you just plan. It's easier to just plan for worst case scenarios. Right, lack of commercial and economic activity. We've seen that with stagnating areas, projects that's not going ahead. So I also know people that bought property in Walvis Bay, and then 3 or 4 of the mines there closed down. I think we're going to touch on this subject shortly, but then suddenly there's just no commercial and economic activity anymore because there's just no more people. So, and then everything falls flat. So that's why I'm not crazy about those one-hit wonder towns. That's either just for student accommodation, college accommodation, or mining town. I know some of them offer some incredible yields, etc. But I'm sometimes just a bit wary of those ones. I just want more reasons for people to live in a certain place. In my opinion, that reduces the risk. So high maintenance requirements. I've seen many of those. That was just badly built. Structural problems, bad rental agents, so many of those around. So what is a characteristic of a bad rental agent? They don't do inspections, they don't do proper inspections, they don't know how to represent you at the rental housing tribunal, and they don't really have a vested interest. And that's why if there's a block of flats and there's 10 different rental agents, and one of them have many units with lots of experience in the area, and there's one agency that maybe have 1 or 2 properties, in many instances they don't care if they give you good service, because if they lose you, you're just one client. Whereas if you're dealing with people that have large rental portfolios, then you're not a number in a specific block, because the word can quickly spread and they can lose that business, which can be significant. I'm not saying that's the case in all cases. The other risk is on the other side, that you can also turn out to be a number, and then service suffers. Some rental companies don't invest in their infrastructure to upgrade service levels, etc., when they get bigger, and that can also be a risk. So bad tenants, I'm not even going to go into that. We're going to cover some of that in our advanced course, I think, where I'm just going to give some examples to bad tenants, from the application process to just the lifestyle, so that we know what is possible and what the potential mitigating factors is to avoid those. Right, bad management companies, we've seen that as well. Bad body corporates or homeowners associations, and I am quite guilty of this one. Of, like I said, those properties in Joburg, I was an absent investor, and many people are. I don't attend the meetings, I don't even send proxies for the meetings for people to represent me, and I just hope for the best. And that's a good example of a bad body corporate. Obviously the trustees of the body corporate plays the most vital role, but I think it's also the responsibility, if you have an asset in that body corporate, to at least attend the meetings, or make an effort to to give someone a proxy to vote on your behalf when there's important things. But like I say, I've been guilty of that, so that is definitely some area that I can personally work on. Interest rate increase. Remember, everything's linked to interest rates. Sometimes what we find is that the rental market actually benefit from interest rate increases because fewer people want to buy. That is not always the case, but that is sometimes the case. So main attraction falls flat. We've covered that earlier. It's like a mining town or one-hit wonder town. I'm not crazy about those. Negative surrounding activities. anything negative, severely negative happen in the surrounding area that can influence demand. And, like an increase in crime, significant increase in crime is definitely something. I know here in the Durbanville area, where there were some crime hotspots, and until, quite a few of these service providers made a big step ups, and the neighborhood watchers as well got involved and really got their hands dirty, it made a big difference. So now people are actually, one of the questions when they're buying in Durbanville, that we find from time to time is, how's the crime, and, how's the neighborhood watch, how active are they? And so people notice those kind of things. It's definitely a factor. Some mitigating factors for risks. So cash flow, we've said, plan conservatively. In that nice software analysis programs, you can go and add additional points to the interest rate, and add things like vacancies, like maintenance, and increase your cash flow requirement, and plan for that from day one. You can even park that money in your bond. Then you've got some reserves there for the event of something going not as planned. Due diligence on properties. I can't emphasize this enough. Learn to do your own due diligence on a property. So stop trusting gurus, agents, friends. When you look at a property, be sure that when you make that decision, that you can be responsible for that decision at the end of the day. Look at rental demand, statistics, capital growth stats, driving forces behind capital growth. We've touched on that before with sub-economies and factors that make some properties more desirable than others. Calculate yields and do comparisons. Put it in the software and take the emotion out and compare it to other properties. So look at your internal rate of return on this property versus another property, and it's definitely a vital part of your due diligence. Building inspections. If you're new to this, get someone involved, a friend that's in the industry, or a family member, or then even go and pay for a building inspection if you must. Even if you just learn from the process initially, but don't just take everything for granted. So be involved where it's possible in the body corporates and the homeowners associations. We've touched on that. Strict tenant screening process, lease with a credible institution. That's also important. So make sure that the people you're dealing with is are managing their accounts correctly according to the regulations of the State Agency Affairs Board, and that they are registered on the State Agency Affairs Board. Remember, you've got extra cover when you're dealing with people that is registered with the EAAB, which you don't have, obviously, with people that are operating illegally. So the tenants, we found that you can minimize the risk probably 98% with a proper upfront process. So when we look at screening a tenant, we almost do it the same way as screening him for finance at the bank, and I think that has a lot of benefits. We go into that a little bit deeper in the next section. Plan conservatively for interest rate increases, maintenance and vacancies. We've covered that. So let's move over. And I just want to say this. The biggest risk is taking no risk. So sitting on the sideline for 30 years and waiting for the ship to come in, that's not going to make it happen. So just remember that we need to take some risk, some form of risk. The biggest risk is actually not taking any risk. Right. This is interesting. So we deal with people, I'm sure you've found some people that have some real horror stories, and I just want to say the fact is you can buy a dud. I'm a living testimony of that. I've bought 3 duds in my property investment journey, and anyone is welcome to contact me, and I'll give you all the details of what I did right and wrong in that respect. So, and this normally could have been prevented with a proper prior due diligence that was that was unemotional and factual based. So, right. But then you also on the other side hear of people that said they lost a fortune in property, and this is a good example. I bought for 500,000. My property is now worth R1 million. I collected 300,000 rental income. I had to spend 20,000 Rand on maintenance, and I had 2 months vacancies. It's a disaster. I hate property. So I don't think I have to say too much. If you read it like this, you'll have the full perspective here. So just be sure when you talk to people and, they share some of their horror stories, that there is a good perspective on what they are saying in respect of the full picture. Right. Tips and advice. This is the last section. It's just 2 slides, then we're done. So how to value a property basics for people that's not, into this at all, haven't done this before. If you're looking at buying a property, obtain the facts of the subject property, your size, your, value offerings in terms of extra parkings, the levy, what's the rental agent going to charge you, what specifics does the property offer in the kitchen and the bathrooms, is it tile throughout, is it granite top kitchens? Those kind of things are important for, maintenance, wear and tear, and obviously resale value and that as well. But then, once you have all the facts of the property, then, a starting point can be a CMA or a Lightstone valuation. CMA is used in Cape Town. I don't think you can use this outside Cape Town. Lightstone you can use throughout South Africa, and I think there's another one, SAPTG as well, that can also give you suburb reports. This is a little bit more expensive, but very valuable information. But remember, this is not always accurate, so don't take this as the be-all and end-all of evaluation. Firstly, it's 3 months in arrears because it's based on transfers in the deeds office, and it doesn't always value the interior of a property accurately. So a 60 square meter flat can sell for 100,000 Rand more, and you wonder why, but if you actually go and find out, then you'll see that the guy next door spent 80,000 Rand on renovations. So that's where the difference lies. So, and that's where these kind of valuations sometimes comes a bit short. So look at comparative deals on the market. Now you've identified your subject property, you've got all these deals. Now go and look at how many of these properties are currently on the market. Look at Private Property, Property 24, Gumtree, etc. and see how many comparative deals you get on the market. But also remember that the advertised selling prices is not necessarily, in fact, very rarely, the actual price achieved. Because in the existing property market, people make lower offers, and so use that as a guideline. Also, we've mentioned this, look at unique selling points, north facing, low levies, security, etc. Try to compare actual property sold in the deeds office, and after all of this, you can determine a realistic price based on the research that it will give you a good idea. I can also give more information with respect to valuations. If anyone's interested, just contact me or come and see us, and I'll gladly share some more information. Right, rental basics. So your rental application is very important. So collect as much information as possible on every single person that will be living in that property. Do they have dogs? That's very important. So, what kind of pets do they have? Screen all occupants. Remember, some people say we just screen the strongest one and then everything's fine. But remember, those 3 people living there, their whole strategy was that all 3 of them will contribute. So, but they will use the strongest guy just to qualify for the rental. But now what happens in month 2, and this is almost guaranteed, I mean, I'm talking out of experience here, is tenant 2 and 3 vacates, or one of them vacates, and the one person doesn't want to pay anymore, and you're sitting with a mess. So if 3 people are going to stay there, screen all 3 and make sure all 3 qualifies. Otherwise, you're just opening yourself up to additional risk. We are part of TPN, Tenant Profile Network, and they actually give fantastic tenant credit reports, etc. We also do ITC and Experian credit checks, because remember, you can have a default or judgment on ITC, but you can be clean on the other one, or vice versa. So the banks sometimes even only do one, but we definitely do both, just to minimize that risk, because we don't want to take chances there. So this is very important and very interesting, we also audit bank statements of potential tenants. So remember, we've had a case before, if I recall, of an attorney, fantastic income, fantastic qualifications, fantastic tenant profile. But if you audit his bank statements, you'll see that in the last couple of months he developed a gambling problem. He's drawing 10,000 rand a year and another year and another year, and it's actually, the amount is increasing. This guy is actually moving into an area of financial trouble, and I don't want him, unfortunately, as a tenant. So that's very important to also audit the lifestyle and spending habits to see if there isn't a pattern of, something that is definitely not desirable in terms of future risk. Right, verify the employment. You phone their current employer, their previous employer. You get some characteristics, some details on who they really are. Verify previous accommodation. This is also important. We've had some fantastic tenants in the past. On paper, they literally, like the one lady I remember, earned 80,000 rand. She had, there was absolutely no red lights on her application. But then after they moved in, we noticed their lifestyle habits at that time, was a disaster. I mean, she had little children, or not little, they were actually, in high school, and they were partying it up the whole time, and there were constant complaints, and we had to actually give a notice to vacate, very soon after she moved in. So those are the kind of things that if you really dig into previous accommodation, I'm sure there's a chance that you can find, some information that can be vital vital information for approving or declining them. Be wary of rent up front. Everyone gets so excited when people want to pay rent up front. I would say, especially in the relatively lower income properties, and also higher income properties. In fact, there's probably no difference. What they tend to do, the guy says, I'll pay. They've got a payout from, a divorce settlement or selling a house or anything like that. They have judgments and defaults everywhere, and then to get past the screening process, they say, right, let me pay you a year's rent up front. And the problem is, when that 12 months has passed, then you're sitting with the troubles. And I mean, we've seen that as well. So be wary of rent out front. Make sure to still do the proper screening process, and to make sure that after 12 months you don't have a problem, because it doesn't help you get 12 months rent up front and then it takes you 3 to 6 months to evict them after 12 months. Then I would have rather said I'd choose monthly rent for a tenant that qualified and which didn't offer potential problems like that. Right, no deposit plus rent, no keys, that's obvious. Look out for suspicious statements and IDs. And this is what the trained eye doesn't see. I mean, we have weekly applications where we catch people out that's got fraudulent bank statements, fraudulent IDs, and it's so easy to slip past someone that hasn't got a great experience in this field. So we go through a different stage screening process here in the office, and it's I actually think I'm going to make a video of one of those applications and point out where things don't where the red lights was on the bank statement, etc. So that's very important. Really, look at the application, look at the statements, the supporting documents, to carefully to make sure that you're not being fooled. We've covered that. Even perfect applicants' lifestyle habits are unknown. We've now gone even into Facebook profiles, just to try and lower that risk. I want to see, is this guy, drinking tots and dancing on tables every second night? I don't want him as a tenant. Definitely not in one of my properties. And so those are kind of things that you can pick up, looking at someone's Facebook profile, because they tend to like to brag about those kind of things as well at times. Righto. And guys, remember, self-employed is a risk. Ensure to consider carefully. 98% of businesses, of startups, fail. Then I think the stat is another 90% of them fail within 5 years thereafter. So there's a reason why banks also don't want to give money to business owners, or can I say self-employed people. They are very careful to do that. And so if someone tells you that, no, she's going to open a hair salon now and she's going into a partnership with that, it might sound like a fairy tale, but remember, she's immediately categorized or grabbed into that 98% risk, and just consider it very carefully, because it's otherwise you're going to sit with a bag of potatoes soon thereafter. Okay, what now? We've reached the end of the presentation. Please subscribe to our mailing list, and we'll share fantastic property investment opportunities, developments, etc. that we are involved in. Also, we'll give updates on our very exciting free advanced property investment seminar, which will include some hot topics: property tax, acquisition, holding and disposal tax, trust pros, cons, and how the latest challenges and changes affect trusts as asset holding entities, 13(6) and 12(j) of the Income Tax Act, and what opportunities they offer, in what instances VAT claimable from the purchase price, financing in current market conditions, do's and don'ts, financing essentials for business owners, commercial versus residential, the long-lasting debate. So let's see what's the pros and cons of each, and then pros and cons of partnerships or sometimes sinking ships. And then what we also as a company offer is professional property rental services in the northern suburbs of Cape Town and surrounds, including advice, administration, education, and professional personal property investment consultation. So thank you for watching the seminar, and we hope you found value in this. Please leave some comments or pop us a mail or give us a shout. We'd love to hear your thoughts and views on this. And and all the best for a profitable property investment journey going forward. Thank you. Hi property people. Thank you for watching this video. I hope you find value and enjoy the content that we will be sharing. Yeah. Hi property people. Thank you for watching this video. Hi property people. Hi property people. Welcome to our